Welcome back, investors. Jake here. In this video, I'm going to be giving an update on my Schwab portfolio. Now, I know a lot of people have recently subscribed to my channel for my Russia-Ukraine war coverage. I'll be giving an update video for tomorrow for the 13,000 people who have recently subscribed to my channel. Welcome. Normally, I talk about finance and investing issues, but as long as this Russia-Ukraine war continues, it is related to the markets, guys. Currently, all of the indexes are green. S&P is up 0.7%, NASDAQ up 1.48%. And you could argue that the market is green today on news that Russia is pulling out of the northern part. This is basically the part north of the capital city of Kyiv, pivoting their war strategy that they don't think they can take the capital city of Kyiv anymore. When you look at this map, Russia had a terrible invasion strategy of thinly spreading out their invasion force of 150 to 200,000 troops, and they just attacked from everywhere, hoping the Ukrainians would feel overwhelmed and surrender, but it's gone so disastrously for Russia. They're basically abandoning this northwest part north of Kyiv, falling back into the border with Belarus, and potentially this invasion force coming from the east, where they were trying to encircle the capital. They know this is never going to happen. They still haven't completely taken control of Mariupol yet. So the Russian forces are pivoting, and more than likely they're going to try and get control of this eastern part. And quite frankly, guys, Russia just cannot sustain this rate and this level of losses they're taking. Ukraine's defense ministry has estimated that they've killed about 17,000 Russian troops in 35 days. So at that casualty rate, guys, I mean, Russia isn't going to be able to fight this war anymore 2 months from now. They basically have to take a defensive position and then try and go to the negotiating table and get concessions. They want territory, they want land. Putin wants to go back to his people and say, all these people died for this. I got you, Donetsk and Luhansk. I got you a land bridge to Crimea, whatever. We'll talk more about it tomorrow. So here is my Schwab account, and I'm positive, guys. At the beginning of this year, I started with $60,000. I was looking pretty good the first 2 weeks in January, and then I got hit by, a truck similar to everybody else, and it was touch and go there. It was pretty demoralizing seeing your count down $13,000 or $14,000, but I held certain positions, took profits on others, and then recently I've opened new positions, and thankfully, year to date, once again, I am positive. So let's go through the technicals of all of my positions. The fundamentals haven't changed because we haven't gotten any recent earnings report. I think Netflix reports next in about 2 weeks. And first, let's just marvel at the fact that the S&P year to date is only down about 4%. It basically was at all-time highs on January 3rd at a value of 4,796. And year to date, guys, we're only down 4% for all of you just buying and holding the index. And that's what I do with a majority of my money in my retirement accounts and my Fidelity accounts. All I'm doing is buying and holding because who could have predicted this? I do technical analysis to once again try and beat the market, outperform the market. But everyone down here was feeling it that potentially the market was going lower. With the war in Ukraine, with inflation, with energy prices, how could the market not go down? Yet, sure enough, after the Fed announced their first interest rate hike, the S&P since March 14th, a little under 3 weeks, is up over 10%. A tremendous run for the market, for anybody just buying and holding. It honestly looks and feels like right now that the S&P wants to get back to all-time 52-week highs. With everything going on in the world, that's pretty crazy. Okay, Let's go through each one of my positions and I'll tell you what I see, what I'm thinking. The first one being HCI Group. If you're not familiar with why I'm in this stock, basically HCI is a real estate holding company that was spinning off a subsidiary to launch an IPO for a company called TipTap. So this stock over the last year ran up huge in anticipation of this IPO offering. It reached a high of 140 and I bought in somewhere around here at like 126. Then when the IPO and the SPAC market collapsed, HCI also collapsed. However, this is my logic here, guys. If the S&P is trying to get back to all-time 52-week highs, then isn't this a good time to be launching new IPOs and SPACs? So I'm holding on to my 100 shares of this company in anticipation that at any moment HCI could say the IPO is back on. They announced after the huge sell-off in the market they were going to delay the IPO until they could get a better price for their shareholders. But if the market is recovering and capital markets, people are getting this appetite back for new companies, then I think HCI will not hesitate and they'll put out a press release saying that the IPO is happening on this date. These are the terms of the deal. If that happens, HCI will shoot back up to probably above $100 a share. So I'm still feeling pretty confident I'm going to get my money back on this position. Currently I'm down $5,395, but you haven't lost money until you sell a position for a loss. The next company is Amazon, and I just own 2 shares of this stock. It's been trading sideways basically for 2 years. And Amazon, this is very bullish, guys. It broke this medium range downtrend and it got back above this level of potential resistance at 3,200. So it's smack dab in the range between $3,200 a share and 3,600. There will be selling pressure once it gets back to here, but potentially this is Amazon's moment and the stock could break out in anticipation for the stock split happening this summer. Whether or not it can break through 3,600 and 3,800, go to all-time new highs, probably it's going to need a good quarterly earnings statement. They probably report in a month. Next company is Google, and Google, I've shown you guys, has had support from this very long uptrend slope going back to the March crash. And I was watching it pretty carefully, but in general, you could say that it's trading between 2,500 and 3,000. And as the market has gone up 10% the last 3 weeks, Google is approaching this line of resistance. So it's either going to break through it and go to all-time new highs, or potentially it'll bounce off of it and start selling off again. However, I think this uptrend slope is going to give it support. I've talked about this in my dedicated videos to Amazon and Google, but I purposely bought the shares rather than a debit spread because if Google or Amazon does sell off back to these lower ends of this trading range, then I'll convert my shares into a debit spread in order to make more money on this trade. Next company is Adobe, and I've got to pat myself on the back for this one. I took this position only a couple days ago, and I'm already up 47% on my initial investment. Adobe is a great company that was massively overvalued. It reached a high of $700 a share and then sold off when all the other high multiplier stocks sold off, and it reached a low of 420. It then had a earnings report in which they gave weak guidance. This didn't bother me at all. There was a sell-off that day and I immediately jumped into it. But right now, I think Adobe, at the very minimum, is trading between this range of $420 a share and $500. Additionally, there's this longer-term slope line going back like 6 years that I think is giving it price support, so I didn't see a lot of downside risk from the level it was at. My price target, as I stated in my video dedicated to Adobe, is I'm just trying to get back to $500 a share. Potentially, if it hits 500, then I will sell to close my contracts, take whatever profit I got. Adobe could potentially break through that level of resistance, go back into the 600 range, or potentially it won't. Objectively, it is, in my opinion, overvalued, but even if a company is overvalued, you can still trade it on its technicals. Next company is Apple, and I feel like everyone the last 3 weeks has been buying Apple. This is the world's largest company by market cap, and has it had a red day in the last 3 weeks? Apple fell to 150 a share, and then it's just been green candle after green candle as the S&P has had green day after green day. Now, this is really interesting for Apple, guys, because we're approaching this previous line of resistance here at 180 a share. And if Apple has a green candle fill above that, that's a very bullish sign. That means that Apple is going to go at least to 190. More than likely, it's going to break out and go to 200. So I'm holding my call contracts. I've been holding them probably about 5 months now. Currently, they're up 97% or about $5,400. And I could see actually Apple breaking through this. I feel like it's due. But if the rest of the market sells off, Apple will just once again drift back down. But there's a longer term slope line that's been giving Apple support for 6 years or so. I don't see Apple falling through that line unless something dramatic and very, very scary happens in the world. Next company is Facebook, and their stock is basically a dumpster fire. I traded this on earnings, which was a terrible thing to do. Lesson learned. Currently down $6,800 on this position. And I've just been watching it, waiting for, once again, Facebook to break a technical barrier that could show that it's going to get back to where it was. I think Facebook fundamentally needs a really good quarter in order for this to happen. But in the short term, this is good news because Facebook's stock got above 220. This was a technical barrier. But it really needs to get back above 245. And if it does that, that's a very bullish sign. I might open a debit spread because if it gets back above this level here at 245, it's probably going to try and get back to 300. There's probably going to be several large green candles in a row as there's not a lot of buyers and sellers with sell limit orders in this range. Next company is Netflix, and in my dedicated video to Netflix, I said they're going to need a hit show. I feel like this stock trades on hype, brand recognition. Netflix reached a high of basically $700 a share. It then fell on earnings. It fell on weak guidance. It then bounced off this longer-term support line going all the way back to 2018. So I opened some call contracts on Netflix thinking, once again, there wasn't a lot of downside risk pending some disaster in the world. But it's going to be interesting because this downslope going back to November, Netflix is going to bump into this in the next 2 or 3 days. I don't think it matters because Netflix is going to give earnings in 2 weeks, and if it's good, it's going to shoot up. If it's bad, I don't, once again, think there's going to be much more selling from this point. It'll probably just trade sideways in a range. The final position to talk to you guys about is Texas Instruments, which I've been holding in my account probably the longest now, and I've just been kind of ignoring it. Texas Instruments sold off with all the other Dow Jones stocks basically after the market peaked in December. It then hit this level of support at around 162. Texas Instruments is a great company that pays a good dividend, does stock buybacks. I wasn't scared of this losing 50% of its value So I just held these contracts. And sure enough, as the rest of the market recovered, Texas Instruments is as well. I still think this level of resistance at $200 a share is going to be a problem for Texas Instruments. So potentially we could get another couple green candles and then it's just going to bounce off of it. I'll reevaluate this position in a couple days and then decide if I want to sell calls against it. Okay guys, that's my update video. I'm still sitting on about $12,000 worth of cash, which I would like to deploy, but given how much the S&P has gone up the last 2 weeks, I think it's better to hold on to this cash in case there's some kind of dramatic drop. The obstacle we're now going to experience going into the next month is earnings season. All of the mega caps are going to be reporting their earnings. Netflix is always the first one to go, so it's kind of the bellwether to signal how potentially will the other mega caps like Amazon, Google, Apple, and Facebook reports. When that happens, let's keep doing updates, and I'm liking seeing the green, but I'm not being delusional that we're out of the woods. There's still a lot of risk in these trades going forward the rest of this year. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. Any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.